We had a little bit of a sell-off in the market here today with the S&P 500 down just over 0.5% today. But we did have a little bit of a rally into the close, so it could have been worse. However, the breadth numbers really weren't that great. Only about 23% of the stocks closed higher here today. We had some really aggressive selling taking place in the industrials and the materials area. We'll also take a look at some of the macro features of today's market, which includes an oversold cluster signal on the US dollar and an overbought cluster signal on gold. And then we'll get into our trade application example, where I wanted to focus on a bearish trade, which is a long put spread on an aggregates company that kind of plays into that theme of construction related stocks struggling here today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 4th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. Keep in mind, David's on vacation this week, so you won't hear from him tomorrow. I'll be back with you on Thursday, and then of course Good Friday is taking place later on this week, so there wouldn't be a video and stock market's not open anyway. But point being, David's gone this week. I'm going to be gone a couple of days early next week, and so especially when we have vacation days planned like this, being on our email distribution list will be helpful, so that way you know what our schedule is and when you can expect to watch those videos. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. As you can see, I've got the S&P 500 heat map pulled up here in front of us, and it was mostly a red day today. We had a little bit of a bounce into the close, but we were kind of testing, almost a 1% down day here today. Keep in mind, considering the very bullish move we've made in the last couple of weeks, even if we had a 1% down day in the end, it really wouldn't have given back much of what the gains have been here recently anyway. But it just wasn't in the cards for the bears today to push aggressively lower into the close. Instead, we got a little bit of a bounce and ended up being down just a little over 0.5% here today. So makes sense that we do see more red on the board than green. It looks like, to my eye, some of the more aggressive selling took place here within the industrials area. I see Caterpillar, Parker Hannifin, Illinois Tool Works. All three of those are great dividend growth companies, but today their share prices were certainly out of favor. In fact, a little bit later on, my trade application example that I'll show you guys will kind of come into this sphere of construction and all that kind of stuff. It seemed like construction was out of favor here today. You'll also notice over here a lot more of those industrials also lower over towards the right. We've got Eaton, that was down about 5% here today. Carrier Global was down 6%. Train was down 5%. Johnson Controls was down 5%. So I don't know if this was a reaction to the JOLTS number or if there was something else going on specifically within the industrials and construction, but without a doubt, they got blitzed here today. Those are some aggressive selling numbers there that we don't see all that regularly. You'll also notice that the energy stocks suffered here today. Especially some of those refiners. We had Marathon Petroleum down 7%. We had Valero down 8%. And then Phillips 66 was down 4.5%. That one we've been kind of watching like a hawk in some of my classes because it kind of looked like it was going to run away from us. But now it's pulling back in a little bit. So that one's kind of flirting with the blue zone on the dividend stair-step charts that sometimes you guys see me bring up. So we're watching that one a little bit more closely here lately. You'll also notice that we have a lot of red in the financial financials once again. Seems like that's been a continual theme here ever since the banking crisis that unfolded with Silicon Valley Bank. So today we had JP Morgan down over 1%. Bank of America was down over 2%. We had Morgan Stanley down 2.5%. Schwab was down 3% today, closed exactly at $50 there. So, Schwab has not been able to gather itself up. While the rest of the stock market has gone higher, many of these banks and in this case a broker that's kind of in the blast zone of the Silicon Valley Bank incident, they have not been able to gather themselves. So financials remain out of favor compared to the rest of the market. You'll also notice down below the materials really struggled here today. In particular, some of those steel names were really down. I saw Nucor was down about 7%. We also had Steel Dynamics that was really struggling today. And if I could brag for my Monday morning class a little bit, this was their doing, not mine, but we use a collective intelligence gathering process in my classes where we use voting to help us with our trade decisions. And the class voted to kick out Steel Dynamics on Monday morning. That was a very timely sell, as that stock was down significantly with the rest of the steel stocks here today as well. So that again kind of plays into that same theme with construction and all that from the industrials heading a little bit lower today. We also saw quite a bit of selling there in technology, maybe not quite as aggressive as some of those other areas. Nonetheless, a lot of those semiconductors down today. NVIDIA was down 1.8%, Broadcom down 1.25%, and Texas Instruments down 2%. You can see a lot of the smaller technology players also in the red here. Microsoft and Apple actually hung in there pretty good. Microsoft was essentially flat today, and Apple was only down 0.32%. So the big kahuna there, they held in there just fine, but it seemed like the smaller technology companies struggled a bit more here today. In terms of the bright spots here today, I would probably say that utilities were a rare bright spot. We see more green than red in that particular sector here today. We also saw a smattering of green in the real estate space. We actually covered real estate investment trusts in my dividend growth investing class earlier today and bought one of those that actually ended up being up on the day. So a little bit of positive action there out of the REITs. And then maybe a little bit of green here in the healthcare area. Should point out Johnson & Johnson, by the way. It was up 1% here today in the normal session, but some of you might have caught my tweet here just an hour or so ago here. After the stock market closed today, Johnson & Johnson received some good news on a settlement of a lawsuit regarding some of the talc incidents that they've been fighting here over the years. And so the stock was up an additional 3% after hours here today. And remember that affects us here in this market outlook presentation because I currently have a sold put on Johnson & Johnson. So when it goes up like it has here recently, that's a good thing because remember when you sell a put, that's a bullish strategy there. So not only do we have a sold put on Johnson & Johnson in this market outlook category that I put on for you guys, but in my Monday afternoon options for long-term investors, we put on a separate sold put trade on Johnson & Johnson as well. So at least for those couple of trades, we're happy to see Johnson & Johnson finally stabilizing a little bit and actually starting to bounce here after what had been a really poor start to the year for that top-notch company. Remember, Johnson & Johnson alongside Microsoft and perhaps Apple, those three are the only three with AAA balance sheets in the United States. Usually it's Microsoft and Johnson & Johnson that get talked about, but I believe there's one of the three credit rating agencies that also throws Apple into that category. So maybe not a clean sweep there, but nonetheless, those are kind of what you would think about as three of the highest quality stocks in the United States right there. So Johnson & Johnson, unlike Microsoft and Apple, really struggled at the beginning of this year, but it does seem like all of a sudden here in the last couple of weeks, they're coming back to life once again. I should also point out that Amazon had a good day, up 1.5%. Amgen, also one of our sold put trades in my Monday class, up 1.5%. And then Alphabet was up just a touch here today as well. So anyway, it was a day that seemed to be focusing on some of the construction and industrial areas for the worst part of the selling, and perhaps a little bit of a safety trade working its way into the utilities here today. Let's take a look at the specific breadth numbers now. Coming over here to the main part of the platform, going to our Market Watch tab, clicking on Visualize, bringing up the Index Watch, and then using the S&P 500 public watch list. You can see here today that 115 stocks closed in the green, and so that was good for about 23% of the S&P 500 there. So definitely a pretty overwhelming day there for the bears today, as opposed to the bulls when it was all said and done. In terms of the end result, it really wasn't quite the disaster that you might assume when you look at those breadth numbers. We were down just over 0.5% today. It was 0.58% to be exact on the S&P 500. The Dow Jones almost matched it identically. It was down 0.59%. The NASDAQ was down 0.52%, so also very similar to those other two. But the one that really separated itself was the Russell 2000. It really struggled today. It was down 1.81%. And remember, that is an area that is going to be more subjected to the difficulties in the regional bank crisis. And with the financials being one of the poorer performers here today, I'm not entirely surprised to see the Russell 2000 be today's biggest laggard from a index perspective. The other thing I would mention is, as you look at all four of these charts, notice that 3 of them have green moving averages. So here it is on the S&P 500. Here it is on the Dow that just started today, so that's fresh. And then the NASDAQ down below here. And then look at the moving average for the Russell 2000. It's red. In other words, we have not yet closed above that moving average, let alone started to bend that moving average up, like is the case with the other 3. In fact, I'd go as far as saying today looks like a pretty interesting bearish setup on the Russell 2000. If you're trying to look for those opportunities, today might have been an interesting time to sell a bear call spread above the moving average, as it looks like it's kind of having one of these reversion to the mean moves and now is starting to get rejected there. Today you did have a close below the low of the high day, which would have been yesterday, at least in the most recent move. And so, we had this pretty consistent upward move on the small cap Russell 2000 index for much of the last week and a half, but today's candle changed the character of that move. It has fallen out of that diagonal upward move and now has broken to the downside. So that does not look particularly healthy to me there on the Russell 2000. But the good news is, the market in general is much more than the small caps. In fact, one of the random stats out there that might be interesting to you is that the market cap of Apple is effectively the same market cap as the entire Russell 2000. That just blows me away when I think about it. 2,000 stocks basically have the exact same market cap as one single company, Apple, here in the United States. So, in the grand scheme of things, if the Russell 2000 decides it wants to stay out of favor while these other 3 start getting a little bit more bullish, I don't think that's the end of the world for most of us. Obviously, if you're trading only those small cap companies, that's a different story. But for most people, especially those of you that probably tune into this presentation, you're a little bit more interested in options trading. And remember, when you're dealing with the mega cap and large cap companies, you're going to have more liquid options to trade off of as well. So hopefully the underperformance of the Russell 2000 is not devastating to most of you watching this right now. The other indices are holding up quite a bit better at the moment. You'll notice here that the background colors of all 4 of our charts are green, which basically tells us that the green line on the market forecast technical indicator down below each of the charts is in bullish territory right now. However, you will notice that the Russell 2000 has this light green background color, and that is telling us that we have a weakly bullish posture there, not strongly bullish. The other 3 are strongly bullish, but the Russell 2000 just is not, getting it together. They don't look the same. As I mentioned before, they're the only one below the moving average. So there's, clear signs that they are the laggard in this market here. currently. In fact, you probably have a little bit of a bearish near-term divergence developing here on the Russell 2000 as well. This is not a textbook example because a lot of times we like to see this blue line. So let me blow this chart up a little bit here so you can see it a little bit better. With this blue line down below, you have this peak right here on March 29th. You have another peak here on April 3rd, which was yesterday. And you'll notice that the two candles associated with those two levels would be this candle right here and this candle right here. Now clearly, price went up at a time when there was a deterioration on the underlying indicator there. But the reason I said it wasn't necessarily a textbook example is more times than not, we would prefer to have this second peak right here be below 80. So maybe not perfection in this case. Nonetheless, it gives you the same sense that there's more than meets the eye when you look underneath the surface. There's a little bit more bearishness than is being accounted for if you're just simply looking at price alone there. So I thought I would point that out. Also, since today was a pullback day and we do have bullish intermediate postures, today's a good day to look for bullish intermediate confirmation signals. And that does exist on basically all of these charts right now. But once again, I will say they are not textbook examples of it. So to back it up a second, for those of you that are newer to the video, what you need in order to have a bullish intermediate confirmation signal is, first of all, you need the intermediate line to be bullish, right? That comes directly from the signal's name, bullish intermediate confirmation signal. So bullish intermediate line just basically means that the green line, which is also referred to as the intermediate line, as you can see in the green label, is either heading higher between 20 and 80 or just simply in the upper reversal zone. And you can see for the S&P 500, it's in the upper reversal zone. You can see on the NASDAQ composite, it's in the upper reversal zone. And with the Dow Jones, it's heading higher between 20 and 80, but nearly in the upper reversal zone. And then the Russell 2000 looks different than the rest, but you could still say that this is a weekly bullish posture. But because that green line is not above the 50th percentile, it's not an ideal circumstance right there. It's not really showing you that the intermediate trend is truly strong, whereas you could maybe get away with saying that with some of these other indices. Anyway, so that's part of that bullish intermediate confirmation signal, identifying that the green line is considered bullish. And of course, you can do that by simply looking at the background colors of these charts if you are a premium member of Market Scholars and have access to them. So that's another way to identify that if you don't want to look at the green line down below. Anyway, the second thing that is associated with the bullish intermediate confirmation signal is, where is the red line? The red line is also referred to as the momentum line, and for that particular signal, we need the red line in the lower reversal zone. And the lower reversal zone, again, is at 20 on the market forecast. You can see here in the label, the momentum line on the S&P 500 is at 13 right now. It's at 16 on the Dow Jones. It's at 16 on the NASDAQ composite, and it's at 16 on the Russell 2000. So for all four of these charts, the red line is in the lower reversal zone at the same time that the green line is considered bullish, although the Russell 2000 is considered very weakly bullish, so wouldn't read too much into it on that one in particular. But the real reason that I mentioned before we wouldn't call it a textbook example necessarily is because while the blue line is not associated with it, with the signal specifically, we like to use it to try to determine if the signal is more ideal or not. And what we like to see is for the blue line to be between 50 and 20. That gives us a sense that there's been a healthy enough pullback, because remember, at its essence, a bullish intermediate confirmation signal is effectively a buy the dip signal. What you're doing is you're looking for a stock that is in the midst of a strong bullish trend, but you have a momentary drop or falling out of that bullish trend for a day or two, which leads you to believe that you have the opportunity to buy the dip and not the fun dip, as I was showing you on Twitter. For those of you that caught that, my attempt to be funny on Twitter over the weekend, buying the dip in the stock market. And so anyway, when the blue line is still up here near the upper reversal zone like it is right now, the blue line's at 77 on the S&P 500. It's actually in the upper reversal zone on the Dow, and it's down a little bit further on the NASDAQ composite. Those are not showing us that there's been a healthy enough pullback, right? And that makes sense. If you're trying to buy the dip, it's hard to justify in your brain that a dip in this case, let's say on the NASDAQ, is a dip of a whopping 0.5%, right? That's not that big of a deal. But with the Russell 2000, you will notice that the near-term line is at 48. So for that one, it's a little bit more where we want the blue line. It's just the problem on that one is that we don't really want the green line as low as it is. We'd like the green line higher. So, none of these are what we would consider to be perfect. But with the Russell 2000 down 1.8%, there you could maybe justify in your head that's a little bit more of a legitimate dip in this case. It's just that you have to combine that with your ability to look at technical analysis as well. And when I look at the Russell 2000 chart personally, I don't really like what I see. It looks a little ugly and sketchy in my eyes. I'd like to have it spend a bit more time above the moving average. So anyway, the signals exist, but I will add the disclosure that the signals don't look particularly perfect at this moment in time either. Let's go ahead and take a look here at our 3 green arrows set up now, and that will be chart 4D for those of you that are following along at home. All right, so let's go ahead and see if any of these charts are giving us 3 green arrows, 3 red arrows, or whether there's a mix here at the moment. And as you can see, 3 out of these 4 charts have a light green background color. And so on this chart 4D, what that means is we do have a 3 green arrows signal. And the 3 arrows that are associated with that setup are the arrow that is registering on the 30-day moving average when price goes above that, the arrow on the MACD histogram, and then the arrow on the stochastic. Sometimes these get bunched up quite a bit down here, so I got to kind of drag that up so you can see them a little bit better. Starting on this day here on March 29th, the S&P 500 delivered a 3 green arrow signal, and it has been in place ever since then. So we've had it for about 5 days at this point. Remember, those signals don't last forever. Down below, like this kind of light green background color here on the NASDAQ composite from right here to right here, and then also on the Russell 2000 from right here to right here. Those are probably on the longer end of the scale in terms of how long a signal would last. So that's another thing that you have to be cognizant of, is you might be able to recognize that a signal exists, but if the signal hit several days ago, you might be somewhat late in identifying that as well. So anyway, those 3 charts that are considered stronger at the moment are proving that through another lens, and that is the 3 green arrows lens, whereas once again we can identify that the Russell 2000 is currently the laggard of this market. It is the only one that does not have a 3 green arrows signal because, of course, it's not yet above its moving average in that particular case. Let's take a look here at our 1040 crossover method. A reminder that these charts are a little bit longer in terms of time that we're looking at here. Each one of these charts is 3 years in length, with each one of the candles representing 1 week. And we do have new information, so I'm glad I'm looking at this here. But one thing I will warn you of, not that it's a big deal, but just so you are all aware of it, remember that when we're looking at weekly candles like we are right now, any signals that emerge from the current week are not set in stone until Friday at the market close. So in other words, you'll notice that 3 of these 4 charts now have given us golden crosses, and that is the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. All 3 of those, again, another way to identify where is the strength. It's in those 3, which means that right now the Russell 2000 is still the only one that is in that bearish crossover mode when you're looking at the 10-week moving average represented by the orange line and the 40-week moving average represented by the blue line. So yet another way to determine the Russell 2000 is out of favor right now compared to the other three. But you'll notice that the other three, I know it's probably a little hard for you to see, so let me maximize this cell. You can see that the background color over this week's candle has now changed to green from last week being red, or pink, I should say, on this chart. And so that's telling us that as of this moment in time, we do have that orange line up and over the blue line. But again, since it's only Tuesday, we can't necessarily guarantee that that will hold by the time things close down at the end of the week. I mentioned a moment ago that usually it's Friday afternoon, but I should have corrected myself because I have already told you guys that this Friday is Good Friday, and so the stock market will not be open this Friday. So in this particular case, we would want to see what happens on Thursday's close. And as long as I remember to, because remember, I will be with you on Thursday. David is out of town right now. Hopefully he's enjoying some sunshine. Some of you saw my tweets here recently. My kid's actually at home with me today because we had a snow day. And yes, it is April 4th. We got hit with, I don't know if it was like a foot of snow or whatever it was, but it's been crazy out here this year. So I'm hoping that David's enjoying himself some time there in Florida and getting some sunshine for the rest of us. Anyway, this week, since I'll be doing the video on Thursday like I normally do, and that will be the final trading day of the week, we'll confirm that day whether we end up closing the week with a true golden cross. Right now, it's looking like the odds of that are quite high. And that's not just on the S&P 500, that's on the Dow, and it's also on the NASDAQ composite. It's kind of interesting that all three of those charts are delivering that signal change on the same week. It usually does not shake out that way. So that goes to show you that the strength in the mega caps here more recently, has allowed them to be a little bit more correlated, at least compared to the small caps of the Russell 2000. Let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this presentation. And while I'm over here, I might as well show you as well, since I was just talking about it. Here's what I was dealing with this morning. So that's me opening up my back door and looking at the snow on my deck. So for those of you that have already mowed your lawn several times this spring, you don't know how lucky you are. I'd like to just be able to see my lawn at this point. Anyway, I appreciate those of you that clicked like for me the last time around when I did the video here last Thursday. As I always say, as long as we're up and over 100 likes on Twitter here, I am more than happy to give you a full-length version of the video. If we're under 100 likes, then we would just keep it nice and short at only 15 minutes. So it depends upon what sort of a presentation you're looking for. That determines whether you're motivated or not to take the 5 seconds out of your day to click like. But just a friendly reminder that these videos are a very big undertaking for David and I. We don't make any money off of them. So we really have to ask ourselves whether it's worth it to do them or not. And for the most part, our sense from dealing with you guys is that it is worth our time to do the videos because you guys get value out of them. But the way that you tell us you get value out of them is by helping us along there on social media. So let's do some shout outs. Thank you to the 107 that got us up and over the hump last time around, including Brandon Walker, including Trunk, including Dean Schultz, Common Sense Investing, George Pin, Arth Ben, we've got T-Fib, Business News, Dana, Maria, Norm, Marley, Vivian, Marley, Caitlin, Damaris, Valerie, John, Peyton, Heather, Roger, Dave, Ayakipa, Dave, Tessa, Sonia, we got Brian, we got Bodicon, there's George and Vernon and Scott and Surendar and NZ Taz. The list goes on and on and on. I can't get to all of you, but I do appreciate each and every one of you. So thank you very much, and please continue that if you want to see a full-length video from me again on Thursday. So you got 2 days to get your likes in there. And remember, there's 4 different ways that you can click like. You can either do it by just coming here to Twitter and looking me up. So twitter.com/Brandon Van Z, all one word, will will get you to my profile, and pinned at the top of my timeline will be the most recent market outlook video. So for those of you that are on Twitter a lot, that'll be nice and easy for you to do. Another way to go about it is for those of you that are watching this video right now on YouTube, if you look in the description of tonight's video, you'll see a link that will take you directly to the tweet in question. If you're watching this video right now directly on the Market Scholars website, there'll be a little widget directly below the video where you can click the heart button on the tweet in question. And then the fourth way is for those of you that are on our email distribution list. If you scroll lower on the emails that you receive each night, there'll be a little Twitter icon that you can click on that'll take you to the tweet in question. So whatever your preferred way of associating with those four different possibilities, it doesn't really matter. Your likes all end up in the same place. So again, appreciate that, and hopefully you guys can keep that up on your end, and we'll do our best to keep it up on our end as well. Let's talk about some of the content I've been producing here more recently. At the month end, I usually do a little bit more of data gathering and statistics gathering, and many of you know that I'm a pretty hardcore dividend growth investor, and so that's usually where my focus and my passion is. The Dividend Growth Investing blog is free on our website. The Dividend Growth Investing classes, of course, are just for our premium members, but if you're out there and you're not quite ready for our premium subscription yet, but you still want to kind of follow along with some of the information and stay plugged in with things, I would invite you to check out this dividend growth investing area of our blog. It is free for everyone, regardless of whether you have a subscription with us or not. And I posted this on the final day of March, as I typically attempt to once I've gathered up the statistics. And what it's meant to do is try to give us a sense of which sectors are currently more attractive for new money as dividend growth investors. And effectively what that means is which sectors have the most stocks that have prices that are out of favor, which means inversely that their dividend yields are becoming more in favor. Most of you know that price and yield are inverse to one another. When a stock price goes down, dividend yield goes up, and vice versa. So what this is telling us here is that communications appears to be an attractive sector for new money for dividend growth investors specifically, and then financials comes in directly after that. So financials, I think that probably makes a lot of sense given what's been going on with the banking crisis here lately. Lots and lots of financial companies, even if they're not directly involved in the crisis, have seen their share prices go down, and therefore their dividend yields have become more attractive as time has gone on. I also reviewed this and gave my general thoughts on the current landscape of dividend growth investing and where we stand here currently for attractiveness in my Monday afternoon Options for Long-Term Investors class. So if you haven't watched that recording yet and you are a premium member that can access our classes, I would invite you to check out that recording from Monday afternoon. And then here earlier today in my dividend growth investing class, I gave my thoughts on this particular blog post, which is the dividend growth investing increases from last month. And the first thing you'll notice is that this month's crop is way, way, way smaller than the February and the January editions. On those ones, I almost ran out of room. I could barely even make a readable graphic. But now that we've kind of crossed over the first 2 months of the year, things will slow down a bit from a dividend growth perspective, at least in regards to the increase announcements themselves. But there were still a number of important companies that did raise their dividends last month, including Best Buy, Colgate, Dollar General, Dick's Sporting Goods, General Dynamics. Who else do we have? Realty Income, that's the monthly dividend company. There's Oracle. We had Sempra Energy, and we had Williams-Sonoma. So, there were some decent ones. Feel free to dig into those details on your own time if you want. But as I mentioned here a moment ago, I did give my thoughts on whether these were underwhelming or overwhelming or in between on a case-by-case basis earlier today in my dividend growth investing class for those of you that are premium members. If you want to check out that recording, if you didn't get a chance to watch the class live. And then last but not least, Here is the sector selector, and a reminder that this gets updated over the weekend. So at this point, it is a couple of days stale, but it kind of gives us a good sense as to where money is rotating to. Now, remember, this has nothing to do with the dividends. This is driven purely by price. So it has nothing to do with fundamentals, business models, dividend yields, anything like that. It is driven purely by how has the price been for these particular sectors. And the way I'm doing this particular graphic is based on an equal weighted system as opposed to a market cap weighted system. But you can see here that technology could be considered this market's leader for the third straight week at this point. Communication services is the second best for the second straight week, and then consumer discretionary made its way up to the number 3 slot after being down at number 5 the previous week. And like I was mentioning to my students on Monday morning in my top-down trend trading class, where we reviewed this data a little bit more to make trading decisions off of, this is really the lineup that you want to see at the top, at least. If you want to see a strong, robust market environment, at least my opinion is that I would like technology, communications, and discretionary to be the leading sectors of that market, and that is where we find ourselves right now. So you really couldn't set it up much better. It doesn't guarantee anything about the future. It just tells you a little something about risk appetite and whether the market is willing to take risk or not. And right now, it does seem like the market is willing to do that. Down here at the bottom, no surprise, financials are dead last for the 4th straight week. Ever since the Silicon Valley Bank crisis, they've been out of favor, and they've stayed out of favor because they got blasted so bad compared to the rest of the market. So even if they had a little bit of a rebound, it's probably going to take a bit of an effort to get them off of the bottom. So we'll keep our eyes on that as the weeks go along. Just a heads up, in case you weren't in my top-down trend trading class on Monday, be aware that, as I mentioned earlier, I'll be on vacation for a couple of days next week, Monday and Tuesday. So my normal Monday, Tuesday classes next week will not be held. However, I am still planning on putting these tools together for you guys over the weekend, for those of you that are premium members. And I'll send that out via Telegram as I typically do. So be on the lookout for that here in the upcoming weekend. I will be back, by the way, next Wednesday. So I'm only going to be gone for 2 trading days, and then Wednesday I will be back for factor-based swing trading first thing in the morning. So anyway, hopefully don't miss too much time there as a result. All right, let's go ahead and pop back on over here to the main part of the platform, and let's do some 12 grid analysis. We're going to get started here with chart 5A. And as this pops up, interestingly enough, the bottom 2 corners are the only 2 that have the dark pink shading. Remember last year, we almost always started our conversation on this particular 12 grid with the bottom 2 corners, but more times than not in 2022, it was those 2 corners we would start our conversation with because they were the only 2 that was green on the board. So my, oh my, how the tables have turned. Now it's the exact opposite. And you can see the benefit that the rest of the financial markets have received as a result. Last year, when the US dollar was strong and the 10-year Treasury yield was strong, most other things were weak in their wake. At this moment, it's the opposite. Both of those are falling off of a cliff, and the rest of the market is benefiting from that. So that's another way to kind of judge risk appetite and where we are in the grand scheme of things. And while there still feels like there's a lot of fear out there in the markets, and for good reason, there's obviously always going to be reasons to fear things. There's never been a perfect market out there. You could pick up a copy of the Wall Street Journal every single day from 100 years ago to where we are at today, and you're not going to see an entire newspaper dedicated only to good news stories. There's always something to worry about as investors. But what we can see right now is that for the most part, participants within the market are willing to overlook the negatives of the market at the moment and concentrate on the positives. And we still have a lot of charts that are shaping up quite bullishly at the moment. Now, as we always joke, whenever David goes on vacation, typically the selling begins, and perhaps we got a little taste of that here today with the market down over 0.5%. So who knows? Maybe give it 3 more days while David's on vacation, and this thing is just going to completely fall apart. But because we had such a good bullish head start before he went on vacation, maybe we will survive this storm a little bit better. But to wrap it up, you can see that the UUP down below here, which tracks the US dollar versus a basket of other currencies, was down 0.4%. This thing has sold off so aggressively, we now have an oversold cluster on UUP. Remember, for those of you that are premium members on these 12 grids, you can right-click on them and then maximize the sell, and then you'll be able to see the actual market forecast technical indicator down below where you can confirm with your own eyes that we have an oversold cluster signal. In this case, we have the blue, the red, and the green lines all below 20 on the same day. So it plots that little dot down below and then has the corresponding dot associated with the candle on the price chart up above. When I go back to the normal 12 grid view, the way that Thinkorswim works is it kind of hides that bottom indicator because there's just not enough room to show everything there. So anyway, it's kind of interesting because about 2.5 months ago, we were dealing with oversold US dollar conditions as well. You can see some of these green dots over here towards the left. And then we had a pretty good rally. In fact, we went straight through the moving average, which doesn't happen all the time, but in this case it did, straight through there to the point we got an overbought cluster signal. Now, it stayed a little bit in that territory for the next 1.5 weeks or so before giving up the ghost, but now we've sold off so much, we're back to this oversold condition. Now, of course, the trick is we never know, is it going to be a standalone oversold condition, or is there going to be multiples of them stacking up next to one another? Back here, you had several of them kind of in the same time period. So could that happen once again during the next week or so? Sure. So we have to be mindful of that as well. But at least we know, hey, we're now getting into that kind of oversold territory where we should at least anticipate the possibility of some sort of a reversion to the mean type of a move in the short term. It doesn't mean that it has to ruin the downtrend that the US dollar is currently in. It just means that very rarely do you see stocks or asset classes go straight down or straight up without any sort of a reversion. So we might be due for a little bit of a push higher in the US dollar. Let's keep our eye on that possibility. With the 10-year US Treasury yield, it was down quite aggressively today as well. In fact, we're probably getting close to a cluster on that one as well. Let me take a look here when I maximize the chart, and boy, oh boy, did we just barely miss it. You'll notice that the green line's at 22 and falling. Remember, if it closed at 19.99, that would have been an oversold cluster signal on TNX today as well, because the blue line and the red line are clearly below 20. So we got awfully close to that. And you can see that the last time we had a cluster on TNX was way back here on January 19th. And that was actually a pretty good day to assume that a reversion to the mean rally was going to take place. You had that downtrend leading into the oversold cluster, and then you had this big reversion to the mean move back higher. Could we be setting up for something similar here? Yeah, it's a possibility. You know, it seems like markets have gotten a little bit too giddy for their own good here on this bullish move to the upside, and perhaps it's time for these macro conditions to give the stock market an excuse to sell off a little bit after a very, very bullish move. So, you know, if we do see interest rates rising here as a result of this, you know, somewhat oversold condition or for any other reason, then that could have a negative impact on the rest of the market. So we'll keep our eye on that possibility, but it does look to my eye that both the US dollar and the 10-year Treasury yield are in the vicinity of where we have to be mindful of a reversion to the mean back to the upside on those charts, which means perhaps some downside selling in some of the other charts that have been so bullish up until this point. You will notice that gold continues to benefit, right? A lot of times that happens when the US dollar sells off. Gold benefits because it's priced in US dollars and goes up. We'll take a look at gold here today. a massive move. It was up 1.86%. We are at new 3-month highs. In fact, look at the little red dot above today's candle there on gold, which means we've got an overbought cluster signal on gold. However, this last overbought cluster signal only resulted in 2 days of selling before going right back up again. So, who knows if there'll be enough to turn the chart around. But the other thing that I noticed when you look at /GC, this is the futures contract itself as opposed to GLD, which we were just looking at a moment ago, which is the ETF that tracks the gold commodity. Here we're looking at the futures contract. And I just wanted to point out that we did eclipse a very big, important round number today on gold. We are now trading at over $2,000 an ounce on gold. So that has been a very impressive move here in the last, let's call it 3 weeks or so for gold, as we've seen that banking crisis unfold. And then the other asset class we've been kind of watching in that regard is Bitcoin. Bitcoin was up 1.5% here today, and you can see that it remains up here near the highest levels of its 3-month chart as well. It's not at 3-month highs the way we saw with gold, but it's near it. So it could happen within a day, right, under the right types of conditions. So both Bitcoin and gold have really benefited from the fallout in the banking sector. And right now, I don't have any reasons to believe that they are in jeopardy of having some sort of huge trend reversal. But like I mentioned before, with the US dollar oversold, there is that possibility the dollar goes up. And if that does happen with gold with an overbought cluster signal, there is that possibility that it would have to give up some of these gains. But the point being, it has such a nice move above the moving average now. I think you can be flexible in allowing it to come down and sell off for a little bit, but it still has a reasonable chance of stabilizing before it breaches the moving average, and then kind of use that as a renewed launching pad higher. So I continue to be more bullish than bearish on the gold markets at this moment, even if I do acknowledge that things are getting a little bit too hot in that area for the moment. They may need to cool down just a little bit, but I do think that the trend is shaping up quite nicely there in the gold market. Oil has been very interesting. Now, unfortunately for the ConocoPhillips trade that I did here recently, which was, I think it was a bear call spread, I had no advance notice of what was going to happen over the weekend, obviously, with OPEC prices. And for those of you that didn't catch it, OPEC came out and cut their production numbers and things like that. And so the oil market just absolutely surged over the weekend. You can see here USO is just one example. This is an ETF that tracks oil, or is designed to kind of do its best to do that, similar to GLD with gold. Anyway, here's that gap that I'm talking about. Here's where USO closed on Friday. And then when they opened it up again on Monday, a massive gap up. There's not anything like it on the chart. You had a bit of a gap down over here, but this gap up is bigger than this gap down. And usually that's the opposite as well. Typically the gap downs are more aggressive. So it just goes to show you this was a dramatic move for the oil markets when that OPEC news broke over the weekend. So it is unfortunate for the Conoco bearish trade that I did. On the plus side, it is a reminder that we never know the future. So we place our bets, so to speak, and sometimes we're going to win, sometimes we're going to lose. But the one good thing about, from a teaching perspective with that bear call spread on ConocoPhillips, even if it kind of runs us over and ends up being a losing trade, remember, we didn't short ConocoPhillips. What we did was we sold a bear call spread, and I think I even talked about it at the time. One of the benefits of doing that type of a trade is that you have defined risk. And so if the trade would rocket higher, we are not on the hook for additional risk as that particular stock would go up in the case of selling a bear call spread. We have defined risk. We knew what our risk was ahead of time, and it can't get worse than that, at least in most instances, unless you really unwind your trade in a strange way or something like that. So I guess that's the good news. It's not fun, placing a trade and then immediately having some random OPEC announcement from halfway across the world destroy your trade in a very short amount of time. On the flip side, these things do happen in the trading arena. The more often you trade, the greater the chance is that you're going to have something like that occur to you, occur to your trade at some point. And so it happens, but the good news is we are defined risk, and so we can afford to take the risk that we did with that particular trade. So anyway, some of your oil trades might be perking up a little bit on the bullish side, but some of your bearish oil-based trades probably struggling here recently with that news. That was one of the bigger gaps you'll ever see in the oil market right there. So what that did as well, you'll notice here that the moving average is now going up on USO. Prior to that gap up, that was not the case. Even Friday's close, you had a yellow moving average telling us price was above a falling moving average in that case. But with that gap higher, it was enough to basically bend this entire 30-day moving average up with it. So now it's almost looking like, gee, could there be a legitimate bullish trend reversal taking place on oil? It's possible, but the other thing that my eye sees at the moment is where we kind of sputtered here in the last 48 hours is exactly where there was this congestion zone back here in late January. So I'm still not sure I'm sold on the idea. Obviously, you've got to respect the fact that there was that massive gap up, and there could have been a lot of people on the wrong side of that trade. But at the same time, until you get up and over this area from January, it does make you wonder if the sellers would be willing to step in at around these levels. So I'll be very curious about that. I still, of the two main commodities, gold and oil, I still think the gold chart looks a lot healthier to me, but oil is doing its best to catch up in a hurry, like one fell swoop type of a move. You will notice here, of course, the bonds are all looking pretty good in general. When interest rates go lower, bond prices, all else being equal, typically go higher. And all three of these bond categories have strongly bullish intermediate postures at the moment. All three of them also have price above rising moving averages. Be aware that the junk bonds actually closed lower today, but we had slight improvements in foreign bonds and then a fairly decent sized improvement in long-term treasuries. And then up here on the top rung, the foreign stocks basically were flat on the day. But remember, that's actually considered a fair bit of outperformance because the market itself in the United States was down over 0.5%. So the fact that EFA closed up by 0.01% and EEM was exactly flat on the day is actually an outperforming area. Remember, that typically happens when you have a weakening US dollar. Foreign assets become worth more in U.S. investors' eyes under that type of an environment. So with the dollar really falling out of bed today, I'm not surprised, and most of you should not be either if you've been listening to these presentations for any length of time, that the U.S. markets the foreign markets easily outperform the U.S. markets here today. Doesn't mean that they will continue to do so. Again, if the U.S. dollar is at a point of oversold conditions right now and then snaps back, then you would assume the opposite would take place and that the U.S. market could very well outperform the foreign one. So we'll keep our eye on that, but right now there's been a really nice move higher, especially in EFA. Remember, that's Europe, Australia, Japan, etc. You can see that with this huge drop in the dollar from basically the first week of March to where we're at right now, and then look at where we were the first week of March to where we're at right now on EFA, those two have been opposite one another. So as the dollar continues to fall, we've had a really aggressive snapback rally there on EFA to the point where it looks like we are actually right there within just a cent or two of having a closing 3-month high for EFA. You'd have to go back to February 1st where it was right there neck and neck with where we closed today. So if we get one more push tomorrow on EFA to the upside, we would break to new highs. And that's really saying something because earlier in this move, I had my doubts about this one. I mean, this did not look like a particularly healthy chart as we headed into mid-March, but we've had one heck of a reversal here in just the last 3 weeks. All of a sudden, it's starting to look like there are some really nice-looking charts overseas. One of them that we've concentrated on in our trend trading class for the last several months has been Novo Nordisk. Some of you know that global pharmaceutical giant, and that thing has just been epic to the upside. And they're not alone. There's a lot of other, foreign companies out there that are starting to perk up. So sometimes we have our blinders on here in the United States because we're fortunate enough to be blessed with a very liquid market with thousands and thousands of stocks to choose from. But every so often, it does suit you to go overseas and look for opportunities as well. And who knows, maybe we're kind of heading into one of those types of moments in the market as well. Let's go ahead and take a look here at our sectors. This will be chart 5C for those of you following along at home. And the good news is we've got a clean sweep of green charts. How about that? It's been a while since I've been able to say that. However, two of them do look weaker than the rest. So those two would be the financials up here where I'm circling, and then real estate down below here where I'm circling. Notice that those two charts have the light green background color, telling us that we have a weakly bullish posture, but not strongly bullish. The other ones have the darker shade of green. Those are our strongly bullish postures. And from that perspective, I would say that the ones that are probably the most impressive are technology, communications. You probably throw discretionary into that conversation, although equal weighted discretionary probably looks a little bit better, at least according to what we saw a little bit back on the sector selector. And then I would throw consumer staples in there for good measure. There's been a really nice turnaround there in the consumer staples. I was mentioning to my dividend growth investors in class earlier today that we had to take the back seat for much of this move in the market here early in 2023. But in the last couple of weeks, our fortunes have changed. And a big reason behind that perhaps is what we're seeing here staring us in the face with consumer staples. I mean, those things have just taken off to the upside. So don't necessarily want to see that from the health of the market perspective. You don't usually want to be led by the consumer staples, but these things were so far out of favor for quite some time that it's nice to see that they have some life after all. And so we'll see going forward. And by the way, you might have caught that when we were looking at some of those metrics on the internet. I was showing you this graphic here. You'll notice that consumer staples is at the bottom of attractiveness now for new money for dividend growth investing. And the reason for that is consumer staples prices have gone straight up, and therefore their dividend yields have gone down and become less attractive. So, that is the reason right there. I think that was maybe a little bit of a surprise when I put that together myself. And I'm like, okay, I guess that does make sense, because I'm thinking in my head, boy, consumer staples have been struggling for so long. But the truth is, those things have been shot out of a cannon here for the last couple of weeks. And so for those of you that were establishing longer term positions in the consumer staples area when they were out of favor a couple of months ago, hopefully you've seen a little bit of upside benefit as a result of this move we've seen here more recently. All right, let's go ahead and take a look now at our trade application example. And for that, I'm going to pull up chart 3A. And a reminder that I do these trade application examples while the stock market is still open, and I send out the trade details via our private Telegram app. Remember, you can't find us if you're searching for us on Telegram. You can get a link from us into our private channel once you become a premium member. And it is a way for us to communicate different things like, changing times for our classes or different class links or trade ideas or what have you. It's just an easy way for us to communicate with our most loyal clients that are out there. And so we put these trade ideas together while the market is open to give our premium members an opportunity to look at them before the market closes, which gives them a slight advantage over everybody else that's just watching the free YouTube video, where they oftentimes hear about the trade idea at night and then run the risk of perhaps missing that trade idea the next day. Sometimes it works the opposite, by the way, right? Because we don't know the future either. Sometimes you're better off having waited a day. So you just have to see how that works out. But in this case, the trade I did today, and the trade that you saw me send out on Telegram, was Vulcan Materials. And this is playing into that theme that I had mentioned earlier when you're looking at the heat map, when I was saying that things like Caterpillar and other construction-related names really got blitzed today, including the steel companies as well. Well, Vulcan Materials, it's an aggregates company that is in that construction theme, and you can see that they did not avoid a sell-off day either. You'll notice they were down about 2.3% today, easily underperforming the market at large. Not only today, but you can see they've been underperforming the the S&P 500 over the last 3 months of this chart as well. In addition to that, we have a close below the low of the high day, which was yesterday. We now have a red moving average once again, meaning that price is back below a falling moving average. We have a pink background color of this particular chart on 3A, where we use it for swing trades because the blue line now has a bearish posture once again. And then the last thing that caught my eye is we do have a bearish near-term divergence signal where you've got your peak in your blue line right here associated with this candle up above, and you have a secondary peak yesterday right here where it is below the 80th percentile and obviously lower than this peak, so a lower high on the indicator. At the same time, you have a higher high on the price from right here to right here. So with all those three things bunched up, what I chose to do was to buy a put spread. So this is not a credit spread. This was a debit spread that I did today. And I chose, I think it was the May contract. So that does mean that we'll be holding it through an earnings announcement. So some of you might not like that, and that's perfectly fine as well, to each their own. But it does mean that we'll be holding it through an earnings announcement. And I believe that the strikes that I chose in the month of May were the 175 puts to buy and the 165s to sell. When I did the trade, it was this stock was trading right at around 170, and what we typically do is we buy one in the money, sell one out of the money. And so in this case, I did have the good fortune of seeing this stock continuing to fall in the final half an hour into the closing bell, which did benefit my trade even more as a result of that. But what I'd like to see ideally is for this company to be below 165 on expiration day in the month of May. If that is the case, then I will make max gain. And for this particular setup, it's better than a 100% return on my risk. I'm risking a little bit under $5 per share to make a little bit more than $5 per share with this. But again, it does require us to hold through an earnings announcement. So this thing could look good up until earnings, and then, maybe they report great earnings and the stock just rips higher and frustrates us, right? So you have to make sure you acknowledge that possibility there as well. But it just kind of looks like one of those charts where you've had this reversion to the mean, but we stay in the downtrend, and now we're bouncing down and away from that resistance of the falling 30-day moving average. Okay, so that's what I had for you here today. If you enjoyed that trade presentation or any of the other metrics that I shared with you earlier in the presentation, then I would encourage you to click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do it on Thursday, I'll plan on doing another full-length version of this video. On the other hand, if you prefer a shorter 15-minute version, then don't click like. And if we're under 100 likes, then we'll just keep it nice and light that day. However, I will remind you that David will not be with you tomorrow like he normally is, as he's on vacation. So no video tomorrow, and then I'll be with you on Thursday. Whether it's a short one or a long one, you guys will decide. Until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.